Let's bring in our headliner, Professor Jeremy Siegel of the Wharton School, Professor Emeritus at the Wharton School, Senior Economist at Wisdom Tree, of course. Professor, welcome back. We're talking about who's a believer and who's not a believer. Are you a believer in this rally? Or I see a headline that you said somewhere that the stock rally is going to end soon. Is that what you think?
Well, NVIDIA, which is a great company, I think is selling for 123 times earnings. NASDAQ is selling for 30.
Well, it's like 50 times.
S&P
for like 50
20
times
no,
forward
let me finish. The S&P, okay, a little less. S&P is 20, which is, by the way, where I think S&P should be at 20. And the small and mid caps are at 14 and 15. You know, if you're a long-term investor, you know, you got to take that into account. If you're a short-term investor, you got to take momentum into account. And, you know, being one of the older people, I think, that you interview, but I think most of the people on your panel, we've lived through the 90s and the internet, and it went much further in terms of dispersion of growth and value back then than it has now at this point. So, yeah, the dispersion is high, but can it get higher? Absolutely. Is the momentum there? Yeah, there are probably more momentum players now than there have been, you know, 20 years ago, although there have always been momentum players. So, you know, in terms of, you know, whether you're a long-term investor and, you know, the small and mid-cap, they begin to stir a little bit. Momentum is still with those high-tech. And if there's any signs of recession, you know, last week, people asked me what was the most important thing I was looking at. And I said, you know, I think the CPI and PPI are going to come in nice. The Fed is going to pause very hawkishly, by the way. They may actually be, I think the dot plot's going to be startling to people because I think a number of them are going to raise their rate projections. But actually, I'm looking at tomorrow's jobless claims because that was a little bit of a shocker last Thursday, and that's the first indicator you might see of softness. Now, again, it's a volatile short-run indicator. But my feeling is what's going to be driving the Fed for the remainder of the year is going to be the real side and the labor market more than the inflation. Inflation is going to calm down. The inflation is basically over. Now, I think I have a chart. I think you guys have helped me prepare that. I don't know if you can show you. Yeah, that the blue... So that is core service inflation over the last year. The blue is shelter, which is the biggest single component. Now, that's because the Fed uses extremely lagged, and I have to say faulty data on housing. We know home prices are down. There was an article in Wall Street Journal today about year over year, housing rates are 0 or negative, but because of the lag way, that blue line is dominating. If you take the blue line out of that, you get core service inflation at 2% or less, which is exactly the Fed's goal. So, I mean, in essence, they have slew the inflation. It is basically gone. There's the residual. There's the data problem. They should stop completely. I think they should have stopped before.
Right.
And I'm worried about whether they stop soon enough, but we will see on that issue.
I'm still confused, though, as to whether you think, Professor, that this rally is about to run out of gas or not.
It doesn't look like it's going to run out of gas. Even with, you know, there may be a little sell-off today at 2 o'clock when we see the dot plot. People say, oh, my God, the Fed is going to get higher. And he's going to take a very hawkish. He's going to say we're going to pause, but he's going to take a hawkish position. And you know, we know the last 6 sessions, we've sold off 200 or 300 points on the last hour of trading on the day that he's come in. So if you want to look very short run, I wouldn't be surprised to see the same thing happening today. Is it enough to slightly derail the tech move? Usually one strike is not enough. It usually resurges again and continues on. There needs to be more of them, and we haven't had more of them yet. So I can see the tech moving ahead and the spread widening in the short run.